The whole market feels like it's in meltdown mode right now, but it's so important for us to lean into the numbers to see what these numbers tell us. And if we do, it looks more like the final trap before a pump up. Bitcoin has been slipping. Altcoins are taking heavy hits and sentiment is scraping the floor. I've been watching my portfolio like I know you have. And yeah, it's been a little painful, not very fun. But here's what matters. The sell-off has clear drivers. And once you see them, you'll understand why I'm staying calm through the chaos. So in today's video, I'm gonna walk you through exactly what's going on, why it does not challenge the bigger picture, and why I believe this sets us up. It's another reason that sets us up for the kind of historic parabolic rally we've all been dreaming of. We've all been talking about for years. So just as a quick reminder, always do your own research. This is just my perspective. It's not financial advice, but I do find it to be my responsibility to bring to you what I find is going on. So let's go. So one of the biggest drivers behind this sell-off is what's been happening in the ETF market. I've been saying this for some time. Whatever happens in the ETF market informs and then has a domino effect on the crypto market. So over the past week, Bitcoin ETFs have bled more than $645 million with a single day outflow of $523 million on August 19th alone. So if you were wondering what has been causing these sell-offs, well, this is one of the biggest culprits. And what happened is the kind of move that makes headlines and rattles people to their core. But context is so important because if you go outside and water's falling all over you, it helps to know it's because there's a storm, right? So context is everything. That said, what's important to realize is that it wasn't just retail. It wasn't the masses of everybody who makes up the market being fearful and not believing in their Bitcoin or in their other crypto tokens and selling them. That's not what caused this. Most of it actually came from hedge funds unwinding carry trades. So it basically means there were big money players closing their positions ahead of the announcement I shared in yesterday's video, which is the fact that Jerome's speech at Jackson Hole is this Friday. And people are reacting now to this news to come. And it's happening in the same way it has every single year since 2022. So it's nothing new. But hang tight because I'm going to break this all down in a bit. The second domino to fall in this correction, and it sets up what usually comes next, is the fact that when this much money leaves all at once, the pressure doesn't stop with ETFs. The next wave is almost always forced liquidations. In the past 24 hours alone, more than 447 million in leveraged positions were completely wiped out. And over 363 million of that came in from longs. Traders who were betting on a bounce got blown out of the water. And if we zoom out to August as a whole, the pattern is even clearer. Twice this month, we've seen billion-dollar liquidation spikes. Each of those days rank among the most brutal wipeouts of the year. And while it looks catastrophic in the moment, of course, is natural, this kind of flush is mechanical. It's not coming from a place of conviction disappearing. It's about leverage getting erased from the system. So this kind of forced selling is painful while it's happening, but it usually clears the path for stronger hands to step in because that's usually who buys up everything that's been fleshed out. And the timing makes sense, of course, because the biggest catalyst of the whole month is only days away. The real reason markets feel so shaky right now is that everything is pointing towards Jackson Hole. Jerome Powell takes the stage this Friday, as I was saying in my video yesterday, which I do encourage you to go check out because these are all like jigsaw puzzles and pieces to a puzzle, and they all build upon each other. So if you want a wholer, more holistic picture of what's going on, I do encourage you to keep up because each series, each video, I kind of assume like you're following. Anyway, so if you do want to catch up, go back and watch it. Anyway, as I was saying, Jerome Powell takes the stage this Friday, August the 22nd at 10 a.m. And traders everywhere, okay, everyone who knows and has been following the market, they know and they're holding their breath. And history, okay, it tells us why. That's because in 2022, Powell's hawkish tone, okay, his kind of negative, pessimistic tone slammed the S&P down 3% in a single day. And in 2023, even as inflation was cooling, His firm stance sent markets lower again. And in 2024, despite a dovish tilt, okay, a little bit more optimism in his tone of voice, the result was the same. Stocks and crypto sold off very, very hard. This event has become a reliable volatility trigger, and nobody wants to get caught on the wrong side. So people are opting for the side of safety and they're just pulling their assets off and they're selling long positions. So obviously, as I said, hedge fund managers that live from managing their money for their clients wisely or conservatively are de-risking. That's why ETFs are bleeding. And that's why leveraged traders are getting crushed right now. Markets hate uncertainty, as I've said again and again in my videos, and Powell is the one voice that can swing sentiment with a single phrase. And institutional desks are already assuming he'll lean hawkish. They're assuming it's going to be a little negative, not wanting to be forced into promising rate cuts while inflation risk still lingers. But here's a twist. Because that view is now consensus, Tom Lee at Fundstrat says the probabilities actually favor a dovish surprise because there seems to be this irony of the opposite happening that people think is going to happen. So now we have Tom Lee saying he thinks it's actually going to be positive. So we'll see. Stay tuned and come back to my channel because I will cover it here in detail. We'll break it down as we do so you can understand. Anyway, if Powell signals softness or even hints at easing down the road, risk assets could rip higher almost immediately, guys. So heading into Friday, the entire market is paralyzed with fear. So know this, do not be surprised. I'm telling you now. But what happens next depends on whether Powell sticks to the script or he flips the playbook in front of everyone because we know he's under a ton of pressure from Trump and his administration and Scott Bessent to cut rates. But a boss doesn't like to be told what to do. So we will have to see what happens. That said, if the short-term fear is all about Powell, the medium-term fear is about the calendar. Okay, two separate fears. Bitcoin's track record in September historically is brutal. I hate to be the bearer of bad news, okay? But it doesn't mean anything if Bitcoin is ultimately going to the millions, right? Doesn't mean anything. I'm just telling you what's happening along our journey together. Because history has said that even in post-halving years, which are typically bullish, September has almost always finished in the red. But we know that red, for us, means everything's on sale for the good tokens, for Bitcoin, Ethereum, Solana, Sui, the blue chips, okay? Chainlink. And traders know this history, and they're already front-running it by pulling risk before the month even starts. Because traders are different, okay? Some traders are traders and investors, and some traders are just traders. So when I say that traders know what's coming, and so they're de-risking and they're pulling their money off and like out of positions now because they don't want their trades to tank, that doesn't mean you should do this unless you're a trader, in which case you should have your own strategy. I'm actually doing a whole video on investor risk profile so you know who you are and how to manage yourself. So that's coming up next week. Stay tuned. But anyway, I just mentioned this because traders have a big impact on the market. And so I'm trying to explain why they are de-risking now. Okay. It doesn't mean you should do it if you are doing this to transform your finances and you're not going to live glued to screens because that is what a trader needs to do to be successful. So if you are trying to build wealth and you only want to hold the blue chips, the ones that you know in the long run are only going to go up, even if it's like up, down along the way, then that is not behavior for you to model. Okay. Moving on. Here is the part that does not get enough attention and what I want to make sure I drive home to you today, which is what comes next. So September may be historically red, a little down, right? But October, November, and December are historically green. They are historically Bitcoin's strongest stretch of the year. And according to CoinGlass, okay, to get some numbers in here, Q4 returns averages more than 85%, with a median gain above 52%, going back over a decade. Over and over again, weak Septembers have set the stage for explosive Q4s, the end of the year. So when I see the current sell-off, I don't see a collapse unfolding. I see things are on sale, as should you. I see the setup repeating, the drop comes first, then the runway clears for the next move higher. That said, let's remember that seasonality is very powerful, but the macro tide matters just as much and sometimes can overrule or topple over as tides do. And right now, the data says the tide is shifting in crypto's favor. The SME FedWatch tool shows more than 80% probability that rate cuts are coming. The Fed still has roughly 500 basis points of room to ease. That's a huge amount of liquidity that could be unlocked once policy turns. And here is the most surprising part. Since March of 2023, the Fed's balance sheet has been shrinking, tightening, not easing. Yet Bitcoin has climbed from 30,000 all the way up to $124,000 during this period. This breaks the old playbook. Bitcoin is no longer waiting for the Fed to add liquidity. It's moving on its own. It's becoming its own force of nature, carving out its pace and its path as a true macro asset. So if Bitcoin can rally this far during a period of tightening that doesn't encourage bullish market behavior, what will happen when the easing cycle actually begins, when they start printing more money into the system? What do you think is going to happen? You have to stay tuned. So now let's pivot to talk about Ethereum because it's the other force of nature in the room. Ethereum has shown surprising strength relative to Bitcoin during this sell-off. In previous cycles, ETH would have collapsed at the first sign of Bitcoin weakness. But this time, it's holding on strong. And this is backed by data. Ethereum ETFs saw a massive one-day outflow of $429.6 million on August 19th, the second largest in history. But despite this, August is still sitting at a net 2.4 billion in inflows, with over 12 billion cumulative ETH ETF flows to date. The treasury bid for ETH is not exhausted. In fact, there's still over 20 billion in dry powder waiting on the sidelines. ETH looks less exhausted both in price and timing, and smart money may be rotating there before it rotates back into high beta altcoins. But there's another layer of pressure that isn't getting as much attention, and that is crypto equities. For years, companies like MicroStrategy traded at a huge premium to the Bitcoin they held. Investors treated those stocks like a leveraged bet on Bitcoin, paying 2, 5, even 10 times net asset value to get exposure to it. And that premium has been evaporating. As volatility fades and the arbitrage opportunity shrinks, valuations are compressing back towards parity with Bitcoin on their balance sheets. Strategy, Michael Saylor's company, is the clearest example. After repeatedly bouncing from a $360 support level, it has now broken lower, falling more than 10% in just a few days. Without volatility, these treasure companies lose their edge in raising capital through financing engineering. The question now being asked is uncomfortable. Could these stocks even trade at a discount to their underlying Bitcoin? If so, it adds temporary drag on Bitcoin itself. But just like the ETF unwinds and the liquidity cascades, this is a structural reset until the Fed pivots, not the end of the story. And here is where it gets very interesting. For the first time in history, we're seeing a pro-crypto US president, a pro-crypto SEC, and regulatory clarity forming around real asset inclusion. Bitcoin and Ethereum's ETFs are now live. 401k access is opening up. The US is no longer selling its seized Bitcoin. It's building a strategic reserve, and there are whispers that they may even begin buying. That would create a sovereign FOMO domino effect like we have never seen. Inflation, we know, is hovering at 2.7%. Slowly approaching the Fed's target of 2%. This is all while the Fed has held rates above 4%, giving policymakers a huge amount of dry powder to cut when they need to. This means the next easing cycle is inevitable, and Bitcoin was designed for this exact kind of environment and moment. And the amount of institutional dry capital here is staggering. According to Bill Miller IV, there are 6 trillion in global retirement funds waiting for access to Bitcoin. We're still early in the process, guys. And as he put it, the dominoes are falling.
Bitcoin, let's hit that before I let you run. I mean, what do you make of it? It topped what, 120 or so, and then it's been pulling back of late. Now, maybe that's correlated to growth and momentum and a little rollover as we've seen it there. Do you think that is the case? And what is your outlook from here?
I do think there's some correlation there. I think a lot of it has to do with Secretary Bessent's interview on Thursday. when he said the U.S. wouldn't be buying Bitcoin or wasn't planning on it in the near term. And then he later tried to walk that back via social media and said they would do it, they would explore budget neutral ways to do it. But I think sellers are missing the forest for the trees here. If you look at 2 days before that interview, the Fed actually ended their supervisory program on novel activities, which effectively means crypto banks. And then a week prior to that, President Trump signed an executive order directing the Department of Labor to rescind prior guidance that effectively kept everyone in retirement plans out of digital assets. There's still legislative work that needs to be done there, but that's massive news. So there are 60 trillion worth of assets globally in retirement accounts with zero allocation right now to digital assets. Every 1% allocation from that 60 trillion adds $30,000 to Bitcoin's price. And so from my perspective, a 2% allocation would be conservative when you consider that all of those assets are currently in a monetary framework whose authorities have told you they want to depreciate it by 2% a year. So why wouldn't those accounts stick 2% of everything denominated in melting ice cube and stick in another protocol altogether? So again, that alone would take us to Bitcoin at 175K or up more than 50% from here. We still think we are incredibly early. We're still seeing early signs of institutional adoption. You look at Norges, the world's largest sovereign wealth fund, almost 2 trillion in assets, has been increasing its exposure to Bitcoin digital assets. It's still a rounding error for them. But when the world's largest sovereign wealth fund, the world's largest endowment in Harvard is now buying Bitcoin, starts to do it, that opens up the door for all the other relevant parties, other endowments, other sovereign wealth funds to do this in a very interesting way. So, we think we're very early in the dominoes falling. Most of the world has zero allocation digital assets still, and we think there's a very long roadway ahead of us.
All right, we'll see you soon.
So when I weigh ETF outflows, liquidations, and Jackson Hole fear against this backdrop, the picture is very clear. This is not weakness. This is infrastructure being laid for one of the strongest cycles we've ever seen. And if you've ever seen a mansion or been in a mansion, the larger the construction, the bigger and the stronger the foundation has to be. So that's what's going on right now. This week's sell-off has been brutal. I know, I'm not trying to undermine it. It's true, okay? ETFs are bleeding billions. Leverage longs are getting wiped out, and traders are bracing for Powell's every word. Fear is in control of the headlines. That's what you should know. Don't fall for them. Just know that it's fear being promoted because it's in their best interest to get all the little guys to sell, okay? 2 videos ago, I talked about this, how the system is not designed for the poor guy, for the little guy, for the underdog. They want to keep everyone under control, and only the rich want to get richer. And that's why, literally, think about who the media is controlled by and the benefit it would have them in promoting fear. So the little guy goes and sells their Bitcoin and their Ethereum and their Solana and their best blue chip tokens so that they can go buy it. Hello. But if we zoom out, the story changes. September weakness is playing out exactly as history suggests. Jackson Hole is just another chapter in a long pattern of short-term volatility. And beneath it all, the tide is moving. Rate cuts are on the horizon, and structural adoption is accelerating, while sovereign nations are starting to emerge with their Bitcoin strategic strategies. So when I look at this crash, once again, I don't see the end of the bull run, and neither should you. I see a trap, and don't fall for it. This is the same kind of trap that has played out cycle after cycle, rinse, wash, repeat. There's nothing new here. The question isn't whether crypto recovers. That's not even a question, guys, so don't worry. The question is whether you'll be ready. Are you positioned? Can you afford to buy more Bitcoin without it affecting your overhead and your bills and your babies and whatnot, okay? Are you positioned in Ethereum and Solana? It's not financial advice, but check out all my past videos to learn why I'm even saying this. You have to zoom out. You have to have patience and conviction because the mega rally doesn't arrive when everyone feels safe. It arrives right after moments like this. And that's exactly where we are now. So I hope you gained value in today's video. I love you guys so much, which is why I bring you all these videos Monday through Friday, no matter what I have going on. And I will catch you guys in my video tomorrow. Ciao.